The actual practice of trading is super easy. I mean, things can go up, they can go down, or they can go sideways, kind of like they are right now. It's not the actual mechanics or the technicals behind trading that make it hard. It's because the markets are made up of irrational markets participants like me and you with emotions and irrational exuberance. And that's what we're going to talk about today. We're going to talk about market psychology. We're going to start off with that term called irrational exuberance. Irrational exuberance simply refers to the times when people are overly enthusiastic about a security or an asset or even the property market, like what happened back when Alan Greenspan coined the term in the mid 90s, and what happened again in 2008, and in 2020 with crypto and stocks and the real estate market, right? People were experiencing that euphoria, that irrational exuberance, and inflating things past their intrinsic value. Like, I fell victim to this. I was sitting right here in this office with my NFTU shirt, working for a NFT company. That did not last long because that bubble eventually popped, but I was irrationally exuberant about it. And that's what really makes trading so hard. So let's dial in on market psychology and look at some ways to become a better trader by controlling our emotions and not getting swept up in the irrational exuberance of the markets at any given time. Before we go any further, let me throw another term at you called the efficient market hypothesis. What this hypothesis refers to is that everything is already priced in. Everything is rational and logical in the market, so you should just buy safe mutual funds and buy and hold and never try to beat the markets or trade. That's efficient market hypothesis or the efficient market theory. I've heard it said both ways. But I just do not believe in that because, like I said before, the market is made up of people and institutions, but those institutions are ran by people. And then some people say, oh, what about the algos? Well, guess what? Somebody has to program the algos, and those are crazy people that do that as well. So I do not believe in the efficient market hypothesis. That's the whole premise of this video, and that's why I feel like markets are super unpredictable. We see this play out all the time within the markets. There's been plenty of times where I've seen a central bank make a decision that should have pushed a currency one way or the other, but it goes the opposite way because they may have said one little thing. So if you're just a rookie investor, you may go in and say, cool, they paused rates, so that means that the currency is going to be a little bit devalued, right? Wrong, because at the end of that speech, Jerome Powell was like, this is a hawkish pause and we're probably going to go up a little bit longer, right? That's all psychological stuff. You have to pay attention to it. That's why I'm not one of those people that's a purely technical or a purely fundamental trader. I like to look at everything. Like, I look at fundamentals, like COT data, like central bank information on interest rates and the economy and jobs data. I also look at technicals and price action. The key thing I like to do is that I don't like to get caught up in any one thing. I want to have a broad overview when I do my trades. Yes, that requires me doing a lot more homework before I enter a trade, but I have a lot more conviction whenever I do hop in, and I have a system I'll talk about later where I can still enter trades quickly with enough information just like that so I don't get left behind. We'll talk about that in future videos, so make sure you subscribe for that one. One thing you will find out about me on this channel is that I'm a huge economics and finance nerd, but I like particular kinds of finance and economics, something called behavioral economics and behavioral finance. There's plenty of great books out there I'll definitely be sharing in the future. But all that means is that people don't behave rationally. These are economics and finance based on the irrational behavior of human beings. So that's why I really like it, and that's what I use in my trading. And remember, it's pretty simple. Behavioral finance just simply means that people aren't going to make decisions based on PE ratios and balance sheets. It's going to be more fear and greed and more emotion based. Same thing with behavioral economics. We touched on a little bit before. Just because interest rates or the EC or the central banks may be saying one thing, people aren't going to really go off those basic supply and demand economics. There's always going to be that human element that's going to skew it each way for each individual person. That's the difference between, and that's all that behavioral economics and behavioral finance means. And I feel like it's what gives me a leg up in the markets because I'm so passionate about it. And I probably read every book on both topics. But let's dive a little bit deeper. Now we're going to talk about the role of market psychology in trading. Market psychology is what gives you that FOMO, or fear of missing out, when you see an asset going up and you want to jump on. Like, I will not lie to you. That happened to me bad in crypto. I made a lot of money, but I lost more. I don't regret it because I learned a lot about the true and intrinsic value of an asset. I'll say the same thing for NFTs. I remember working for an NFT company, and you cannot go wrong with any asset, right? I remember trading NFTs back and forth. Me and my friend would sit here every day and just see things fly. Back between 2020 and 2022, they had no intrinsic value besides being on the blockchain, but it was just so many, things got oversaturated. But my market psychology and that fear of missing out caused me to kind of chase that and go with the trend. I go back to that Warren Buffett quote when he says, when people are fearful, be greedy. When people are greedy, be fearful. And I already knew that quote, but I couldn't help it. It was so many people talking about it. Like, I worked at Apple at the time, and it was customers and employees and people from young to old come up to me like, hey, have you bought Bitcoin yet? Have you jumped into Ethereum? Have you heard about this new Shiba Inu dog moose coin, right? It was crazy. And I couldn't help but to get caught up into that irrational exuberance. And I tell you what, right now we're in a position where maybe, just maybe, if rates get cut again in 2024 and Bitcoin gets halved, we could see that irrational exuberance come right back around and see more asset bubbles. Here in Australia, I see that housing prices are kind of doing the same thing that they did in America back from 2005 to 2008, when things were super overinflated and it caused a crash. I don't hope the same thing happens to Australia, but I'm seeing a lot of the intangibles like variable interest rates and people being overextended on their mortgages that led to that same crash that happened in America in 2008 right here in Australia between 2020 and current date. We'll see, but we'll definitely talk about it on the channel as it unfolds, and I'll give you guys some trading strategies to kind of trade and still make money in those markets. That's why I love trend following. I don't care if things are going up or down, I'm still gonna make money. I won't lie, trend following is a little bit harder when things are going sideways or consolidating, kind of like right now due to the interest rates being held, but it's still possible if you diversify across securities and assets. Anyway, now let's talk about how to identify asset bubbles. This is super simple. Let's not overcomplicate it. If you see something going up and you get that little spidey sense going off in your head and you're like, why is this? I don't understand how this is just going up so high in value. Like we've seen it with GameStop and AMC when Reddit got behind and went against the short sellers with Melvin Capital and some of the other hedge funds to try to take them down. It was no value behind GameStop. Like, they've been ripping people off since the 90s, but it was the power of a crowd and a bunch of Redditors that pushed that thing through the roof. If you hadn't seen it, there's a great Netflix doc that covers everything. But if you weren't under a rock those past few years, I'm sure you know all about it, especially if you're watching a video like that. But that was a sign of a bubble and irrational exuberance. Eventually that ride had to end, no matter how fun it was. The same thing about NFTs. Like, I went as far to get a job in blockchain, and I was super passionate about it and still have some interest in it. But I just went too far because everything was going up. The price of Bitcoin was at 67,000. Like, Bored Apes were 300,000. It was everywhere. We had VCon popping off. It was insane. So I got caught up into it. But if I would have kind of slowed down and stepped outside of myself, I probably would have realized that, hey, this is a bubble that's probably going to pop. I seen the same thing with the housing market between 2005 and 2008. And like I said before, I could possibly be seeing the same thing happening right now here in Australia. So it's pretty simple to identify those signs of irrational exuberance and potential market bubbles, but just slow down and look at things. And if something doesn't feel right, it probably isn't. Some strategies you can use to safeguard your portfolio against those bubbles is simply diversification and, yes, risk management. My favorite two words. If you find uncorrelated assets, you'll be able to kind of spread your risk around. That's why I'm a huge fan of ETFs against individual stocks, but I also like treasuries in a time like right now when stocks are down, treasuries are up. When gold's down, that means the dollar may be up and vice versa. Those are just inverse securities. We're gonna go a little bit deeper in that. I don't want to confuse you right now in this early stage of the channel, but just remember, diversify, 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 and try to find things that aren't related to kind of safeguard it. And most importantly, risk management is paramount. Like I said in an earlier video, don't YOLO all of your money in. Like my trading strategies, I trade anything between 0.25 to 1% of my capital, even when I have high conviction on trades. It just varies depending on the market sentiment and how I'm feeling about a trade one way or the other. I don't throw everything in because I can live to trade another day. That's super important. There's so many people I still see on the internet that threw all their money into Bitcoin or NFTs and they are hurting right now. Like, bro, in the hurt locker because they had no risk management. They treated it like gambling and just threw it all in there. People often ask me, what's the difference between trading and gambling? Well, I say it's risk management, right? Like with gambling, you kind of throw it all out there and let it ride. With trading, there are ways and there are strategies and edges you can develop to have a little bit more control and to have tighter risk management than when you're gambling, unless you're just throwing it all on black. It's also super important to know where we're at in the sector or market rotation. If you want to find out more about things like sector rotation and figuring out where we are in market cycles, be sure to subscribe to the channel because those videos are coming up. And you probably should watch this video right here if you want to find out how to create trading plans based on your personality type. Until next time, this is Mind Over Markets with Michael T. Ragland. I am out. Peace.